Good morning, and you are welcome to the last part of our working capital lecture series. And this, I think, will be part 5. And we are looking at cash management, all right, how you manage your cash in the office. Don't forget, we have done the introduction and we have done inventory management, we have done receivable management, we have done payable management. Now we look at cash management. Your areas of examination when it comes to this for a financial management paper is reasons why people hold cash. All right, so that is one, reasons for holding cash. Why do we hold cash? There are basically, we have 3 major reasons why we hold cash. As you can see, first objective for holding cash is a transaction motive. Of course, everybody needs money to transact. So to buy things, your day-to-day expenses, to meet up your business need, you need to have cash. That is that. So just to go around your activities. Then we have precautionary motive. We save money against unforeseen circumstances. So we are told to do health insurance. It's a form of saving money, transferring risk. All right. So for unforeseen emergencies, you have been asked to keep money that in the future there will be a need for it. So you are keeping money for precautionary motive. But some people also keep money for speculative motive because they want to take advantage of the market, especially when it comes to foreign risk management, foreign exchange management. Right now, we are gearing towards Christmas. People believe that if you are a Ghanaian and you hold dollars, the prices of dollars are going to go up. So they are holding dollars. They will exchange it for a higher CD value. So people do that just to be able to benefit from speculation. So that is it. Of course, then we have second thing you need to learn is failure to carry the effect of mismanagement of cash. Mismanagement of cash. So if you mismanage your cash, you realize that as a business, you won't be able to purchase at discount because you have to have the cash available so that you can buy things at a lower price. In my personal experience, like I always tell you, that if you go to Kumasi and you are buying stuff, all you need to do is to make sure the cash is available. You can actually buy the thing at your own terms, not at the terms of the supplier, because you have the cash. All right. You may lose suppliers' goodwill. You may have poor industrial relations, potential liquidation. If you don't have cash, the ladies will even run away from you. Yeah, so these are some of the things that you should know to make sure that you are managing your cash very well. The third thing that we will do will be about the cash management models. The cash management models. All right, so, and these are the 2 most examinable areas that you need to pay attention to. But of course, there is a trade-off for us to discuss. Ability to pay bills as they fall due to take advantages of opportunities is the side of the liquidity. Also, minimizing the holding of cash, an idle asset. You have an idle asset, and it's better for you to invest it. So what we are saying is that if you pay the things, like if you pay your bills, it's good. You are able to take advantages of opportunities that comes at once. So liquidity means let's keep money so that we will be able to pay. But if you are not using the money to invest, how can you also make profit? So those are the 2 dimensions. That's the trade-off. As we are saving money so that we are staying liquid, investment opportunities are also sliding us by. So profitability. So if you have money at the bank right now, which is not probably any interest, then why don't you invest the money for the money to generate return? So those are the trade-offs, all right? So those are the trade-offs. Now, of course, you need to learn how to do a cash budget, but I'm skipping that because that is a pure management accounting perspective of it. So you have to learn that from a management accounting perspective. But as far as financial management is concerned, um, we are going to focus on the cash management model. So in your book, even though this is financial management, the budgeting of cash is part of cash management. And so therefore you have some questions in there to deal with. So if you are doing man accounting, you still even need this book because investment appraisal, long-term decisions are also here. All right. So you need the book so that you can even practice your cash budgeting here. All right. So that is that. But we go straight to the cash management models where we are going to discuss two major models. All right. And those are the areas that fit into your scope of examination for financial management. All right. Now let's come to the cash management models. And here we are going to discuss two major models. The first one is called the BOMO cash management model. And the second one is the Miller-Orr cash management model. All right, so these are the two that we are going to discuss. Now, the BOMO is just like the way we used to do the inventory. All right, so here it's just like the inventory thing where it says that you need to do an EOQ. All right, so the EOQ here has a different meaning. All right, so you need to get the different meaning of it. So you do your EOQ as we used to do the same analysis, 2COD all over CH. But here the variables have different meaning. Okay, so what it means is that EOQ is your cash investment. CO here, we look at it as your transaction cost. So transaction cost include issue cost, brokerage cost, commission cost, all right? So any cost you need to incur to make a transaction happen. So we call it the transaction cost. So which includes brokerage fees, issue cost, commissions, and all those things. Any middleman that you have to pay to get the job done. Now, what is D? D here is demand for cash, all right, for the period. Demand for cash over the period or for a period. Then what is CH? Cost of holding cash. All right. Cost of holding cash. So for this, the model is just trying to suggest that when interest rates are high, the cash balance held in non-interest bearing current account will be low because your figure is not going to grow by the interest. All right, so that is that. But it also tells us that the weakness is so it says that the weakness is the unrealistic nature of the assumption on which it is based in. This assumption is not for real. Basically, that is that. So would we get these ones? Transaction cost, cost of holding cash, and all those things. Now, if you are holding cash, the cost is the opportunity cost of you not using the cash. Yeah, what you would have used the cash for to get you the benefit, you are not using it for it. All right. But when interest rates are high, it says that the cash balance in your non-bearing interest should be low. But in reality, nobody does that. People still keep money when interest rates are high. So per what it is trying to say is that if interest rates are high, it means the cost of capital is going to be high. So why don't you use your money to invest and get a more return? So you're saying that your cash investment is a function of all these variables. So basically, that is that. Now let's take an illustration to demonstrate how we apply this to a question. So it says that the company generates 10,000 per month excess cash. That's what it generates. All right. And it says that which it intends to invest in a short-term security. The interest rate it can expect to earn is 5%. Then the transaction cost associated with each separate investment or fund is 50. Then it goes on to tell you that what is the optimum amount of cash to be invested? B, how many transactions will arise in each? So that is kind of ordering the number of orders, all right? Then C is like, what is the cost of making the transaction per annum? Then D, what is the opportunity cost of holding cash per annum? So these are the questions that you are going to answer. Now, the first one is the optimum amount. So this is the optimum investment that ought to be done. So in this case, 2 is 2. What is CO? CO is the transaction cost. All right, the transaction cost. How much do you have to actually incur? Commission, interest, brokerage. So it says that the interest it can expect to earn is 5%. That 5% is a sample of your holding opportunity cost. Don't forget, every time we talk about holding cost, the first thing you must always remember is opportunity cost. But it also says that the transaction cost associated with each is what? 50. So CO is 50. D is annual demand of cash. So let me even add annual, like the way we used to do in inventory. So here it is 10,000 per month. You have to convert it. All right, that is make it like 120. Then your 2 is also given. So it's just a simple analysis of 2 multiplied by transaction cost of 50, multiplied by into bracket 10,000, which is also for 12 months. All right, so that is that. Then your CH, opportunity cost, is 5%, 0.05. All right, so when you do this, that is where you have your figure that is there as 15,492. So that is what you have. And this is in cities. Don't forget that. Now, then you have been asked to talk about the number of orders. Number of orders is simple. You see, if you want the total cost of an order, what do you remember? Is D divided by Q multiplied by CO. Is that not what you do? But here, we don't need you to multiply by the CO because it will give you an amount. So what you will just do is take your D, which is your annual demand, which should be 120, and the Q, which is 15,492. So when you do that, the number of orders is actually 8. All right. So that is the number of transactions is 8. All right. So 7.75. You have to round it because it's an order number. All right. That is that. Then you have been asked to do what is the cost of making those transactions. What is the cost of making the 8? So that one too, you just make it simple. The annual cost of making those transactions. Every cost that you do costs you 50 pesos, 50 cedis. Every transaction that you do, the annual transaction cost. Every transaction you are doing is costing you 50 pesos. So how many transactions are you going to do out of your orders? So that is it. How many transactions are you basically going to do with the orders that you have? So it's a simple cut. You are going to do 8 orders, all right, out of the demand that you have. 8 orders out of the demand that you have. So all that you do is that if every order costs you 50, then it means that I'm going to do 8 orders and it is going to give me something like 400 cedis. So that is it. If you use the 7.52 is the same, it's going to be 7.75 multiplied by 50 and that will give you something around 387.5. So basically that is that. I rounded this. So that is that. So please ignore this division. All right. So that is that. Okay. So basically that is it. Now, your opportunity cost is also here. You have to calculate it says calculate your annual opportunity cost. That is simple. You know how we do it, your holding, right? Holding is equal to Q over 2 multiplied by CH. So basically, that is all you are doing. All right. Basically, that's all you are doing. But herein, you have to be careful because it says that the opportunity cost is into percentage. So you have to convert it. All right. You have to do the conversion. So 0.05 multiplying. So this is just like the way you do it in the inventory, the holding cost. So opportunity cost is part of holding cost. So basically that is what you have. It's as simple as that. Then you go your way. All right. So that is what you see here, your holding cost. All right. So that is it. I hope you can practice the illustration to yourself. There's illustration 5 here, where a company faces a constant demand for cash of 200. So D is 200,000. All right. Then when you go on to read, it now tells you that it replenishes its current account, which pays no interest, by selling a constant amount of treasury bill, which is held at an investment, and that investment is earning 6%. So what is that? CH, opportunity cost, holding. The cost per sale of treasury bill is fixed at 15 per sale. So that is that. That is transaction cost. So that is CO, 15 cedis. What is the optimum amount of treasury bill that should be sold? So if you have a question like this, it is basically asking you to do your EOQ. So Q, the optimum amount, is given by 2 by 200,000. Then 15 all over 0.06. All right, so let's calculate that. So that will be 400,000 multiplying 15 all divided by 0.06. All right, so that gives me like 10 million, right? So it gives me 10. So to put 00 somewhere, I can, is it 10 billion? Yeah, that is what I have. So you can corner 0 somewhere and put it in. All right. So that's like 10, like 100 million. 0, let me count the zeros. So 0, then 3 zeros, then another 3 zeros. So if I put it in the square root, that is 10,000. All right. So basically, that is that. All right. Basically, that is that. All right. So the question is telling us that what is the optimum and how many transfers will have to be will be needed, and what will be the overall transaction cost. So it's the same thing that we did. Okay, so if you are going to do this, then let's do the order. The order is demand over Q. So how many? Demand is 200 over 10,000. 3 zeros cancels 3 zeros. So here you are having like 20 orders. All right. So the question that is asking you how many transfers that will have to be needed is 20 transfers. Then it says that what will be the overall transaction cost, the transaction cost to be if the order is 20. and every transaction costs 15, then this one will be 300. All right. So basically that is that. If you ask you to calculate the opportunity cost of holding, then you will do the holding cost, whereby you need to get your Q and divide it by 2 and multiply it by your 0.06. So here Q is 10. So then you do that. That's as simple as this is. All right. So that is that. That's all about the BOMO. Just have to get your figures right. So this is it. I think you need to cancel up this 50. All right. Then you are sorted. Then the next one, the next model that we need to learn is the Miller-Orr. All right. The Miller-Orr cash model. That one is always examined a lot. Miller-Orr cash management model. That is simple. So here we are going to use the formula. So Miller-Orr is just about controlling your movement of cash. All right. How do you control the irregular movement of cash? So you set up some upper limit, set up some lower limit on your cash balance. So upper limit is the level beyond which cash should not allow to be. So if you get your salary, you can say that I'm not going to spend anything more than 1,000 Ghana cedi or 1,000 USD. All right. So you set up some limit. All right. So that is that. Because of that, you will always make sure that you have some form of cash balance in your side. All right. In your home. And here there are the formulas that you need to learn is, first of all, is the return point, cash return point. All right. So the return point is your lower limit plus 1/3 of your spread. 1/3 of spread. So somebody can also say lower limit plus spread over 3 is the same thing. All right. Spread over 3. That is that. But how do we get spread? So you calculate your spread. So your spread is given by 3. You create this whole big column. Then you do 3/4 of your TC, your transaction cost, multiply by your variance. All right, your variance of cash flow. Okay, then you can close that multiplying your interest rate. I'll give you the figures for the definitions of the transactions, the T. Fortunately for you, this formula is given in the exams. It's always given to you in the exam, this one and this one. It's just that the way they quote it is a little different, but it is given to you in your exams. But bear in mind that this one is variance. All right. Take note of that, because the examiner is used to giving you standard deviation. All right. So please take note of that. So here I quote for you that the variance and the interest should be expressed in daily terms. Take note of that. So if it is given to you in monthly or yearly, you have to requote them in daily terms. Now, also the variance, take note of it, because you may be given standard deviation of daily terms, which you will need to square. So you have to square it. I didn't say you have to square root it. I said you have to square it. So square the number to get your variance. Basically, that is all. So you can do that, and you fix it into your equation for the return point, then that will be it. Which means that your lower limit is something that you can be given. It is the level below which cash should normally be allowed to fall. If you fall below that, then it means that if emergency comes in your life, it's very difficult. So you should have to always have some money for maintaining your what do we call it? Your life in terms of emergencies. Okay, so that is that. That is that. So calculate the lower limit, get your variance right. Then you need to learn how to also calculate your upper limit. All right, so you need to also calculate your upper limit. So let's go ahead and learn how to do this, because if you know your lower limit, then you add it to your spread. Not, you see, the spread is 1/3. Return point is lower limit plus 1/3 of your spread. But the upper limit will be your lower limit, then plus your spread. All right, so that is that. Upper limit is your lower limit plus spread. So these are the only three things you need to learn how to calculate in this model, and you just evaluate it. So let's take an illustration. Whilst we are working with the illustration, I will explain to you how you evaluate the following. All right, so that is that. Look at this. We have the following data. Minimum balance, that is the lower, right? So that's the minimum balance, not necessarily the lower. Minimum cash balance is what they're giving us. So that is that. That is the money they assume to be the balance below which cash should be allowed to fall. That is that. Then you take this one to be your variance. And don't forget, this one is variance, daily variance. So we don't need to square root anything. The equivalent standard deviation is this. So if you were not given the 4 million, you could just do square root of 3,000. You get it. All right. So that is that. Then we have the transaction cost. That should also be in daily matters. Don't forget that. It should also be in daily matters. The transaction cost should be in daily. All right. So quoted in daily. Then the interest is also given per day. So you see all the information here are all in daily basis. So that is that. Then you are required to formulate a decision rule for using the Miller form. So it's very simple. I think it's even done here. You can see it already. So just do what we've done, the formula. So repeat the formula. So just this. All the figures have been given, calculate it, then this is your answer. I said round it over here. So your upper limit, therefore, will be your lower limit plus the spread. That is what you see here. Then your return point is your lower limit, 1/3 of the spread, and that is what you see here. Now, what does this mean? It means that if the cash reaches 33,300, how much can you spend to bring it down to its lower limit? So basically, that is the idea behind that. So it says that if the cash is balance, which is the 33,000. What is the 33,000? The 33,000 is your upper. So it means that you cannot go beyond that 33,000. All right. So it means that we can use part of the money to actually go into our securities. And the return, so this is it. You can actually spend the return point. So that is all. If your cash reaches 33, which is the highest, you can only spend the return point. So basically, that is that. So you can spend the return point. But if cash falls below 18,000, the 8,000, then it means that you need to, so this is your return point. So your return point is 6,400. So it means this is the point where you can come to or you should get to. So you can come down to that point or you should get to that point. So it means that if you are, your limit is 8,000, then it means that you need to save an additional 8,400 to be able to get to it. But if you are also at 33,300, then it means you can spend out of this, an amount out of this to get this. So how much can you spend? That is what you have as 16,900. So that is all that it is trying to say. So basically, that is that. This is where you should be getting to. So it means that you need to sell to have that cash back, to get yourself back to the return point. So basically, that is the idea. If I leave you with another illustration, can you work it? So this one, for example. Do you remember your formula? And that is something, this one, if you don't remember, you are fortunate that it still will be given to you in your exam. So multiply by TC variance, all right, all over interest. Don't forget, all these things are supposed to be a daily affair. You get all around then 1/3 of it. Okay, so minimum cash balance, that's the lower limit they have now, is 20,000. Is required at Mela or. The transferring money to or through the bank is 50. So that is your transaction cost. So 50. TC is 50. And they said that inspection of daily cash flow over the past year suggests that the standard deviation is 3,000. You know, they've given us standard deviation. We don't need standard deviation. We need what? Per day. So it's 3,000 per day, but we need variance. So variance will be equal to standard deviation square. And how much is that? 3,000 square is like million, 9 million. So that is that. Then we are told that, okay, so it was even given, imagine. It says that the interest rate is 0.3 per day. So 0.3. Please, is 0.3%. So it means that you need to introduce in additional 2 zeros. So it will be 0.0003. All right. So take note of that. Take note of that. Now, if we calculate, let's do it 3/4 of 50. 9 million. 0.0003. All right. So do that. So when you punch this, I have like 31,200. And this is spread. So return point is lower limit, which is what's our lower limit in the question? 20,000. 1/3 of spread. So that gives me 31. This is it. So 1/3, 33, 1/3 of, if I add, this is 10,400. So you can see, then if I add, I'm having 3,400. Then what is my upper limit? It is 20,000 plus the spread that I had before, 31,200. And that is 51,200. So it means that if my cash flow is here, I can spend some out to be able to get here. My cash flow is here. I need to sell more, 10,400 to be able to get here. That is all the explanation needed for that. All right. Okay, so that is that. So I'm going to leave this one for you. Do it. So let's go to the past questions. This is so quick. We've had this thing in November 2021. I think there's another year. Yeah, August 2022. Very easy. So pray you get cash in your setting. So this is the example. You are an assistant, you are the assistant to the finance manager of Hoffman Holdings. The director of the company, the directors of the company are reviewing the cash management practices. All these things that you read as part of the question is just a debriefer. So you come here, you are told that on usage of cash, you found out that the company's daily cash needs vary with a standard deviation of 25,000. So that is it, 25,000. You have your first line of item being 25,000. Now, the question you need to ask yourself is, what is this 25,000 for? So what is it for? They said it's standard deviation, but we don't need standard deviation, do we? We need variance, daily variance. So this 25,000 square will be how much in terms of the variance? So 25,000 square gives me a huge figure, which is 625,120, then another 0, then another 3 zeros. Okay, so this is it. So I found my variance. However, annual demand for cash is around 65 million. So that one, the question you need to ask yourself is that what do we use that figure for? What do we use that figure for? Because when we were learning, we never said anything like annual demand. We never said anything, but we know there is a transaction cost. So you have 65 million, and sometimes the question must give you the whether the thing is days or what. We need the days, how much transaction cost per day, variance per day, interest per day. We don't need any annual demand. If there is an annual demand, then it means that maybe you'll be requested to do a BOMO too. Be careful. So that is that. It says, considering your examination, your boss proposes a minimum cash balance of 100,000 going forward. So what is the 100,000 for? Yes, your guess is as good as mine. That is your lower limit. 100,000. So that is that. So the question is, what do we do with this one? This is annual demand. So maybe, let's see, maybe you'll be asked to do, what do we call it, a BOMOL analysis. But without that, we don't need the annual demand for our work. We don't need it. What are we left with? We don't have transaction cost yet. So let's go on to read. From your search on the market, you found out that the company can earn interest from an investment at an annual rate of this on an actual 360 days count. So it means this one is not 365, it's 360. And the interest, they said annual interest. Don't forget, we need daily interest. So we will do 21.6 divided by 360 days because we need daily. So 21.6 divided by 360. And that is 6%. So 0.06%. All right. So that is that, because there is a percentage here. So it's 0.06%. All right. Take note of that. You found out that the average transaction cost is also given, and that, so TC, average transaction cost, is 2,500. So your boss recommends Mela All right. If he comments Mela All, he said that calculate the cash spread between the lower and very easy. If you want the cash spread is your spread formula, which, if you remember correctly, is a big 3 here, then 3/4 of 2,500, which is your transaction, then the variance of 62.625 million. So you can write all over this. So you introduce in 2 zeros because it is like this. All right, good. Then 1 raised to the power 1/3. So how do you go about this? So you can do always like I do, you do what is in the brackets. So you have this multiplying 2,500. Okay. Then you have 0.006 to deal with. Then you are multiplying everything by 3/4. Also square rooting everything over 1/10. That has given me 125,000. everything that I've done in here. Then I'm multiplying it by 3. And that gives me 375,000. So that is my spread. Then this one, of course, is in cedis. This one says the cash return point. We know how to do RP. Return point is lower limit. In this case, our lower limit is 100,000 plus 1/3 of this spread. So divided by 3, that is 125,000. So it means here is 225,000. That is my RP. And it says that the cash levels at which the company should invest excess. The cash level at which the company should invest temporarily the excess. What is that? You should know that that is upper. So that is 100 plus 375,000. That's 475. That's all. You do this, how many marks is that? 5, 7. That is it. You go your way. Of course, there will be theory like, why do you hold cash and all those things? There will be theory. So you add that. Yeah, these are the theories. So explain them. And like I always say, ask for the theory, get the book, it will be helpful. So this is the processes we went through, and this is the processes. So the one question is saying that, would you say the BOMO will be more appropriate? So the CEO believes that BOMO is simpler model than the MELA or, and your board should consider recommending that to the directors. Considering the information provided in the preamble, would you say that the BOMO would have been appropriate? Do you have all the information to do the BOMO? Because the only thing I saw there was the annual demand. Yeah. The only thing there is the annual demand. Of course, it looks as if there's also the transaction cost, right? Yeah. But do you have the cost of holding, cost of ordering? All right. So that is that. So you explained that. So the remaining theory, there's another question that happened in August. So cash is very cheap. First of all, the question said that a J department stores has been quite volatile recently with the standard deviation. So this one too, you are giving standard deviation. So you know that you need variance. So variance is equal to SD square, therefore 60,000 square. So let's count it, 60,000 square. That is a huge figure. The figures, when you square these things, are huge. You may be tempted to think you are wrong, but you are not. So I have 36 here. Then let me start counting the zeros. 1, 2, 3. 1, 2, 3, 1, 2. So it's 8 zeros. 1, 2, 3, 4, 5, 6, 7, 8. So this is the figure that you have. Yeah. So that is that. Then it says that the managers are therefore considering using Miller or to manage cash. The minimum cash balance, lower limit is how much? 300,000. The annual interest is expected to be 18. Interest is 18.25, but you need what? How many days are we using here? The question has to give us the assumption of days. If we are not giving, then we are going to stick to 365 days, all right? So for example, in this one that you don't really have your days, then it means that you have to use 365 to divide this. So if I do 18.25 divided by 365, that is 0.05%. So that is it. Then what else do we have? The annual interest, while the cost of trading in an investment security per transaction, yes, also that one to daily transactions is 10,000. So it means that my TC is 10,000. I have all I need. All I need to do is to design the formula. 10,000 TC variance. 3600,000,000. Interest 0.0005. 1 is 1 over raised to the power 1/3. All right, so you go through this and you convert it. I am getting a figure, very interesting figure, which is 1133928. Okay, let me do 0.96. So this is what I have. So that is it. And they said I should calculate the cash return point. That is RP. So RP is lower. My lower limit is 300,000 divide plus spread over 3 or 1/3 of spread. So that is all you do. And that gives me 677,976.32. So this is it. Upper limit is this lower plus this figure. All right, so it will start from here, 300,000. So all you need to do is make this 1,4. So it will make it 1,433,928.96. As simple as that. That's all. Explain how the minimum cash limit, upper cash limit, cash return point will be used to manage. Okay, so it's as simple how to manage a J departmental store. So that's the explanation of your answer. If you get to the upper, it means that you can sell some out to come to your return point. If you are lower of your return point, then it means you have to kind of if you are the upper, it means that you can buy, you can spend, all right, so that your money can be reduced to the return point. If you are down, which is your lower, under your lower, then it means you need to sell to get cash to your return point. Basically, that is all. All right, reasons for holding cash, you explain it, transactional, speculative, and what precautionary. So explain them, and that is it. All right. So ladies and gentlemen, this is where we end the cash model management. Okay, so that is that. We did this thing in time value of money, how to do the amortization table. So if there's any or such, you do it. There are questions about the whole working capital we have done. Aggressive, explain these ones. It's theory, we've done it. All right. So in the introductory stage, these are theories, and I would ask that you take your time and go through them one by one. All right. So, and there are other questions here, ordering cost and all those things. Calculate the cost of inventory of raw material using economic order quantity. Determine whether they should accept a discount. We did the discount stuff, if you remember. So don't be lackadaisical about it. These are the questions left to be answered. They can be lifted and you may find yourself wanting. So make sure you go through them. Of course, that is the more reason why you need this manual. All right. That is the more reason why. Oh, my video is off. That's the more reason why you need this manual. You need them. All right. Because I have a financial reporting manual. For consecutive times, you realize that the questions that are compiled in the financial reporting manual are what are being used to examine you. So why waste time? Get the books, all right? So a little clue, check your FR book. A student opened my eyes to it. Check your FR book. Check the question called diagram and graph. Just multiply the figures by 3 and compare it to the exams that was done in March, July, your consolidation question. Check SALSTAR and compare it to your March 2024 question. You see what I'm talking about? So get the books, get your pass. Thank you, and God bless you. Bye-bye.